When it comes to payment processors, Visa pretty much takes the cake for pretty much all of them. It is essentially a duopoly between Visa and MasterCard. I know you have some kind of like American Express here and there, but aside from that, really it's just Visa and MasterCard. And in my opinion, Visa is even stronger. They have a bigger moat than that of MasterCard. So I would like to analyze today Visa and see if their fundamentals are actually in line with their ticker price. So let's just get started with that in this episode. But before we do that, let me just remind you to, of course, like, subscribe, comment. Really does help here with the algorithm. On YouTube, you can follow me on my new tech sites of BitChute, Odyssey, and Rumble, where in addition to my stock analysis and crypto videos, you will get exclusives as well. Alright, so with that said, let's get started with this analysis. Starting off, the dividend summary. Visa actually does pay a dividend of, look at this, guys. Look at this. It's so cute. 0.71%, which ends up being around 38 cents a share for an annual payout of $1.50. Now, you're probably wondering, what in the world is this dividend? This is so tiny. It's $1.50 per share annually. That's ridiculous. Here's the thing though, their growth rate is completely insane. The 5-year growth rate on this dividend is almost at 18%, which is just massive. And whenever you have a company that has a really low dividend, you really want to take a look at their 5-year growth rate on this dividend, because if their 5-year growth rate, their CAGR, is very high, that tells me that, well, yes, right now they have a low dividend, but they might be able to continue the 17.94% consistently for the next coming years, meaning that you will get a higher dividend growth than other companies, like for example like Chevron or something like that, right? So that's just something to note. Payout ratio in regards to their net income of 21.28%, which is really good. Dividend growth, they have grown their dividends consecutively for 13 years. Ex-dividend date unfortunately already passed on November 10th, payout date on December 7th, and they pay out their dividends quarterly. Now coming here to the new and improved calculator. If you didn't see my PayPal video, just want you to know I made a new calculator. It's not made it new, it's more like just improved it. Added a couple things here and there. You'll see later in this episode. But we got the ticker symbol V, market cap of $440 billion company, PE of 44.52. Again, we would like to buy this under 20. 44, this is already telling me that this is very much expensive. Current share price of $208.74. As we saw, annual dividends is about $1.50, and I already put all of these metrics in, so we know that based on the shares outstanding, they pay out about $3.2 billion in dividends every single year, which in regards to the free cash flow, their affordability after paying this, they have about $8.2 billion left, which actually ends up being a payout ratio in regards to their free cash flow of 27.78%, which is actually really good. We would like to ideally buy anything under 60. They are at barely 30. So when it comes to this, so far the only metric that's kind of iffy is the fact that the PE is too high. So it's telling me right now that it's a little bit expensive, but we're gonna find out by how much. Now coming over here to the actual metrics, we got the net income, $6.7 billion to $12.3 billion. That's an increase, guys, of 54%, which is just crazy to think about. More than half. They have increased it more than half within the past 5 years. Next, we got the free cash flow. And guys, free cash flow is by far, I would consider it the most important metric when it comes to their income, their profits, right? Because free cash flow is essentially cash from operations minus capital expenditures. It is cash in, cash out. This is by far one of the best metrics. It's actually the easiest metric to understand, mainly because it's that simple. It's also very difficult to manipulate. When it comes to income, when it comes to revenue, they have SEC regulations that companies have to follow, and they can be manipulated easier. Free cash flow is a little bit more difficult to manipulate. But regardless, we got $8.6 billion to $14.5 billion. That is an increase of 41% with an average 5-year free cash flow of $11.4 billion. That is absolutely incredible to see. Obviously, 2 years ago, they did have a little bit of a dip, But maybe they were just doing a lot more capital expenditures, right? Because again, it is cash from operations minus capital expenditures. So in my personal opinion, I suggest you go out and look if maybe during this year they did a lot of capital expenditures. Maybe they took a lot of their cash from operations and reinvested it back into their company, right? That's not necessarily a bad thing. Just because the free cash flow is low during that time doesn't necessarily mean that, well, they used it for something that wasn't necessary, right? Next, we got the revenue, and 5 years ago it was $18.4 billion to 1 year ago of $24 billion. Guys, that is an increase of 23.84%, essentially 24% within the past 5 years. Now coming over here to the debt. And ideally, we would like to have a company with little debt, because debt is what tells me whether the company was going to weather a storm or not. If things hit the fan and we go into a recession, well, the company with the least amount of debt is going to survive, right? So in regards to Visa, it had $18.4 billion in debt to currently of $21.6 billion in debt. That is an increase of 15%. So I don't necessarily know what's going on here, right? They did have a lot of debt. They issued a lot of debt 2 years ago, actually, and then 1 year ago they just brought it down. And even this current year, they pretty much just kept it the same, right? Though I think this is mainly because they have still yet to put in next year's numbers, right? So they're just counting last year and this year, at least on Seeking Alpha, as the same, which explains why, well, they're the same. But regardless, this is still an increase of 15%. Next, we got the shares outstanding. And again, this is one of the most important metrics that tends to be overlooked a lot. You want this to be decreasing. The more a company issues shares, the more you're going to get diluted. You do not want to get diluted, right? You want the company to be buying back shares. That way, it gives you, the investor, a bigger piece of the pie. And as you can see right here, Visa is actually buying back shares at a pretty good rate, from 2.3 billion shares to 2.1 billion shares, which is a decrease of 7.24%, which is actually pretty healthy. It's not too little at like less than 5%, and it's not like they're putting all of their cash flow into buying shares, right? So it's a nice healthy balance around 7%, which is really, really good to see. And lastly, we got the cash and equivalents, and well, as of today, they have about $16.5 billion in cash and equivalents, with an average cash and equivalents of about $12.5 billion. Now coming over here to the part of the calculator that I actually made significantly better, it is my assumptions, my growth assumptions and my required rate of return. I made this so that instead of just having just one growth assumption and one required rate of return, which let's face it, I always had a 8.5% required rate of return, and then the growth assumption would just fluctuate, but it really didn't give it that good of a, I guess, prediction when, let's face it, maybe the company could be doing this, maybe the company could be doing that, and therefore I decided to make this one that actually has three assumptions: a low assumption, a median assumption, and a high assumption. So for my low assumption, I'm going to assume a growth assumption of about 15% with a required rate of return of 7%. Now, I'm mainly saying 15% because, guys, it's Visa. I know this may seem high, but it's Visa. They have a duopoly with MasterCard. That's it. There's literally nobody else. American Express, but let's face it, like, I don't even know anybody who even uses American Express, right? It's either Visa or MasterCard. That's it. Period. End of story, right? Maybe Apple Pay and Google Pay, but those aren't credit card processings, right? So growth assumption 15%. Required rate of return, I'm going to put the lowest that the market usually does, which is around 7%. Now for the median assumption, I'm going to assume around 20%. And for the required rate of return, I'm going to say around the highest of 10%, which is the highest that the S&P usually does. And for my high assumption, I'm going to say 25% growth assumption with a required rate of return of around 13%, which is really, really pushing it, right? Usually the market does anything between 7 to 10. I'm going to push it beyond that, and I'm going to say 13. And with those assumptions, for the low one, we get a target share price, not adjusting for debt, of $213.28. For the median one, we get $147.55, and for the high one, we get $120 essentially. Now, adjusting for debt, however, this goes down to $211.84 for the low assumption. For the median assumption, it goes down to $146, and for the high assumption, this goes down to $118.52. Now, obviously, these are the numbers that we get based on the target share price before and after debt. However, we would like to put in a margin of safety just in case something were to happen, right? Because again, the more you pay for something today, the less returns you will get in the future. So you want to compensate for that. Now, I'm going to assume a margin of safety of 5, 10, and 15%. And for the low assumption, regarding those margins of safety, we would ideally like to buy this at $201.25, $190.66, and $180.06. For the median assumption, we'd ideally like to buy this at $138.81, $131.50, and $124.20. And for the high assumption, we would ideally like to buy this at $112.60, $106.67, and $100.75. Current share price, guys, is 208. So yeah, this needs to fall by a lot, right? I mean, assuming the highest growth assumption, if you would like the lowest required rate of return, it's pretty close to that one, right? Assuming that it's going to grow 15%, but you're only going to get 7% return. It really is up to you, right? Me personally, I would ideally like to buy anywhere between the median and high assumptions of like the 10% to 15% margin of safety. That to me is like my sweet spot. So anything between $106 and $138 to me would be the sweet spot. But it's really up to you. If you don't agree with my assumptions, well, I'm actually going to have this calculator public probably tonight as of I am recording this video. So by the time this video is up, the calculator should be up, the newest one. I am planning on making a how-to video on like how to use it because it is slightly different than the original one. So, you know, be on the lookout for that. But that's just that. To me, this is a good company, but right now, guys, it's really, really expensive. You will want this to drop. All right, so with that said, like if you like, comment, subscribe. It really does help here with the algorithm. On YouTube, you can follow me on my news tech sites of BitChute, Odyssey, and Rumble. In addition to my stock analysis and crypto videos, you will get exclusives as well. Alright, so with that said, peace out and be on the lookout for the next stock analysis video.